morning and welcome. So over the next 15 minutes or so, I'm going to talk a little bit about Mercia Technologies, which is focused on the funding and development of technology businesses across the UK, but specifically with a strong emphasis on the Midlands, North and Scotland, which are underserved regions. And by this, what I mean is that we invest in limited liability, private businesses that many of you will not get to see. We access these, and I will show how we access these. We move these through on a high growth trajectory, and we're trying to move this from a cash-to-cash basis. So we are creating businesses on a strategic trade sale basis, and we're looking to get a cash-to-cash return on that. We have listed actually one of our businesses, and I've partially unwound our position from that, but predominantly we're looking at trade sale basis for our investments, underlying investments. We came to the market in December 2014. We raised £70 million with a number of specific targets for that capital to invest further in the direct investments that we already hold, to add to those direct investments, and actually to look across the UK on a consolidation basis as to whether we can acquire other fund management businesses and integrate them into our own to scale our own offering. And that will become evident as to the importance of that in a moment. Focus, I think, is a clear element that you're going to hear today, particularly in today's market. And we are a very focused operation indeed. We focus in terms of the sectors that we invest in. So we are not a generalist investor. Indeed, we're not even a generalist technology investor. And you'll see by the investment directors, the venture partners that we operate against. We have specific technology verticals that we go into. So digital entertainment, and I'll talk to some of those in a moment. But we have a stand out in the back. We have our virtual reality, a VR player going on through that. I encourage you all to have a go on that. We have a speaker system and from one of our audio investments. Again, I encourage you to look at that. So we are investing in businesses with product, businesses in revenue growth, not in ideas. So again, as I said, I encourage you to come and listen to our stand. Life sciences is another sector we invest in, but not into the therapeutics. What we're investing into is businesses that we can move through on a very modest capital basis into revenue. So diagnostics, services, medtech businesses. And again, I'll speak to some of those in a moment. Advanced materials engineering, specialist manufacturing. We have a number of businesses from that, which is not surprising considering we're headquartered in the Midlands and moving across that area. And finally, electronics, hardware, and software, and we'll talk to that in a moment as well. The regional focus is absolutely key and is one of our differentiators that we're very proud of. As I said, we're based in the Midlands. We invest nationally, but predominantly across the Midlands, the North and Scotland. And to bring that into sharp focus, if you can see these, but within the South East here, so you can see here from the 2014 BBCA statistics, 2.7 billion of venture capital was invested around London, 1 or 2 hour journey from around London. And that brings into sharp contrast the fact that there was 200 million invested across Scotland. And it isn't there's a disproportionate amount of opportunities. We'll have heard of FanDuel and things like that going across Scotland. It's because access to capital outside of the southeast is very, very challenging. And frankly, we're making hay in that area. We see limited competition for deal flow. We can price sensibly and get into very attractive assets. And again, I'll bring those into sharp focus in a moment. We have 14 university partnerships. Approximately 50% of the investments we make are university derived. And those universities are exclusively across the territories we operate against. So in the Midlands, in the North, in Scotland. And you'll see that we have very much a proactive deal flow approach. So we seek opportunities in subsectors and sectors that we see high growth opportunities in. And our university partners relate to that as well. So for instance, we have a partnership with Abertay University, Abertay based in Scotland, one of the leading universities in the country, if not in the world, in terms of digital, in terms of gaming, and in terms of cybersecurity. 3 areas that we think are very exciting areas to be investing in. And then the businesses at the bottom here are university spin-outs that we have invested in and have flowed through. The next point, which is really worth spending a minute or two on, and I have a minute or two, so worth spending a minute or two on, really relates to the funding model that we operate, which is in some elements quite different to what goes on in the sector, but reflects actually the reality of investing in technology and in young business, which is it will take typically 7 to 15 years from first investment to a liquid return. And so you require a model that can embrace that patience. And this is the model that we've been developing since 2007, actually. So although we came to the market in 2014, we've been practicing this model. And the model is a hybrid structure using third-party funds on the one side and direct investment capital on the other side. So before we came to the market, we were managing our third-party funds and we were investing our own capital as follow-on capital to those emerging stars, and I'll talk to that model now. So on the one side here is the access to, as I said, the private businesses from our university partnerships, from accelerators, incubators, but actually predominantly from our investment directors' personal networks. And when you see our investment directors, you'll get why they're accessing those sort of opportunities. These third-party funds are a tax-efficient structure called CDIS and EIS introduced to the government to encourage private investors to invest in young businesses and bring them through. We bring those private investors together under funds, we raise a fund per year and invest it per year. And so we'll seek a project, a product, a company, we will either create or move the company through, and we will spend 2 to 8 years building value in those businesses through our third-party funds, not through the capital that we raised on the market, but through our third-party funds. We're building management teams, we're building boards out, we're building the business model, route to market, and importantly, revenue. And central to all of our investments we're making is rapidity to revenue and modest capital needs. And we develop and grow those businesses on this side, and as I said, over a 2 to 8 year period, at which point we class those as emerging stars. So a selected few come out of this funnel and across to our direct investments. And those emerging stars are now in significant revenue growth. And so although not completely de-risked, they've had a lot of risk taken out on this journey on this left-hand side of the equation. And there are 2 very important features that we've developed over the years that lend this model successfully in our hands. The first is preemption rights. Because we're raising a fund per year and investing it, the fund, and we typically take a 20 to 40% stake on this side of the equation, is that preemption right is lost because the fund has no capital. But we are able to invest through whichever fund or whichever source of capital we have against that. So if we own 40% of the business here, we can then invest 40% of our rights across on a direct investment basis. And that's important because if we're creating solid and strong investment prospects over here, we don't want to lose these to a third party, and that locks it into the equation. The second point, which is important for our private investors and for our institutional investors, is permitted transfer provisions. Our holdings here are held under a nominee, which means we can pass them throughout the group. What we do here when we invest directly is we give our private investors the chance to sell at a significant discount, but they still have the option to sell to us. So not only do we build our position in this emerging star by investing directly into it, on a sort of pseudo-secondary basis, we provide our private investors the opportunity to exit. And at that point, we reset the clock. That's day one for us. But for our investors, it might have been 7 or 8 years into the journey. And that gives us the ability to take a 7 to 15 year opinion from day one to when we seek to trade sale these businesses out. And this is a really important model and a model that we've been scaling. And hence my point about adding to what we call the funnel over here and looking at other funds and fund management businesses as we build a funnel that lets us select direct investment prospects. And then the final point, but frankly the most important point, is the team that we're privileged enough to have within Mercia. And we have investment directors that come from the range of sectors that we invest against. So as an example here, for instance, digital entertainment, which is an important subsector of ours, is a quarter of our deals and investments we're making. Mike Hayes heads up that vertical. We have an investment team in digital entertainment. We're one of the leading investors in this space. Mike used to run, and some of you will know, I know, Sega Games. So Sega Games Mike ran until 3 years ago. He ran the global operations, say, for Japan. He didn't run that. What he doesn't know about gaming in the entertainment sector is not worth knowing. He headed up the acquisition team within Sega. And so what we have been doing is rolling out an investment basis against the acquisition targets that Sega had identified. And as I said, we have a VR player outside, Endreams. Please go and have a look at them. But that's a good example. 3 years ago, we'd set our stall ahead of the market, frankly, that VR and AR were going to be the places to be. We have successfully built what is probably one of the largest VR developers now in our portfolio. And that comes from the investments director's insights into what strategic trade sales, so strategic assets, are available across the sectors we're investing in. Peter Dines, he's got a strong medtech and diagnostic background, and in fact, he's taken 3 of his own businesses through to a successful trade sale. Rob Johnson, he's got a strong background in the sectors we operate, in particular software. And what Rob's done is he's sold 5 businesses, 3 of which were his own and 2 for others. And all of these individuals here, these 4, are successful businessmen and have successfully exited. I personally believe in backing success, and these people have been very successful in the past. And Mark has got a successful track record of building businesses as well in the sectors that we've selected against. So each one heads up the sector, and as I said, a team below him. Nicola is slightly different in terms of what Nicola's background is technology transfer. Universities are great sources of investment opportunities, but slightly difficult creatures to work with. And you require somebody who has lived and breathed that sector to be able to work successfully and politically, frankly, with those businesses. And Nicola heads up our 14 university relationships. We have a very strong board, but I guess everybody standing up here will say that. In terms of the executive, my own background is actually academic, I was an Oxford academic, moving through technology transfer at Oxford ICES Innovation. I was fortunate enough to spin 5 businesses out when I was there. Some of them you may have heard of. Actually, if you've been watching the news, Oxitec, the Zika virus, there's always somebody coming from Oxitec on there talking about that. Oxitec was University of Oxford spin out. I spun that out, Luke's business. Natural Motion, Torsten's business. I spun Torsten's business out. That was acquired by Zinger a little over 18 months ago, $300 million. And 3 others which actually went on to float. So those businesses, I was very fortunate enough to spin out those, and I learnt my way through that, and I learnt this need to know what you're investing in and have patience to support those businesses. Martin Glanfield, my CFO, has been on 4 listed businesses as a CFO in the US and in the UK, has a wealth of experience in private business as well, as an incredible asset to the executive team. Matt Mead is our Chief Investment Officer. You need that venture capital discipline for portfolio balance and moving these assets away to that trade sale basis, and has 20 years experience at 3i through technology investing and exits. And then the board reflects actually the businesses that we operate against. So Ray Chamberlain, I talked about us supplying our own capital and moving these things along. Ray was a significant provider of that capital, a successful entrepreneur in his own right, some £50 million made in personal wealth, and has been a big driver in this model going forwards. Susan Searle, some of you may know, founder and ex-CEO of Imperial Innovations. When she stepped down from Imperial, joined our board. Martin Lamb, IMI, PLC, FTSE 100, he took that share price 7-fold while he was there. When he stepped down from IMI PLC as CEO, he joined our board. And certainly last but not least, Ian Metcalf, managing partner of Rags, national, very well-known national brand legal firm, provides that necessary corporate governance and oversight of the board operations and investment activities. So in terms of balance and the portfolio that we have created, so when we came to the market, we had some specific uses of funds, as I said, about direct investments and about building our stakes. So the reason why these are 2 grade ones is these are on our stand so that you can actually have a look at what we've done rather than just hear me stand up and say how great they are. So Dreams came through our third-party funds, and when we listed on AIM back in December, we had a 7% stake in Dreams. We have a 40% stake, so we've been building our position in Dreams now. And across our group, so including our third-party funds, we have a 47% stake. Warwick Audio, they're out on our stand. When we came to the market, we had a 10% stake in that. We now have a 62% stake in that. So we've been building our position in valuable assets. And what this graph shows, what this table is showing is, at the very bottom are the businesses that are sitting. We have 50 businesses that sit within our third-party funds, technology businesses. And these are ones that have yet to come across as direct investments. These are our low revenue, pre-revenue, and actually they range in age from 2 to 8 years, coincidentally. As we make a direct investment, these dark blue lines represent the direct investments, and the numbers in percentages represent the positions we have through direct investing. So these are the stakes that we hold in these businesses. And we have approximately 20 direct investments now, of which we would argue 12 are core valuable assets that we see high growth opportunities in there. And they range across the sectors that we talk about. And as revenue grows towards profitability, that's how this is structured. So for instance, Alinea, we came to the market with a 9% stake. We have a 20% stake. Direct holding, we have a 28% across the group. That's a very profitable business, and we actually get dividends from that. But when we came into it down here, it was an idea from the University of Warwick. And we drove the management team, we drove the board to now what is a very profitable asset. And actually that asset is currently in our hands, and we're evaluating trade sale opportunities for it. So we deliver that value as we drive these businesses through, and revenue is a key metric in when we're doing that. Dreams, which I've spoken to, please go and have a look on the stand. I think you can access the slides. I think the important thing to take note here is we have partnerships on this. So we're with Oculus, you'll have heard, that was acquired by Facebook for $2 billion. Partnership with Samsung, HTC, Steam, Sony, and recently Google. And a couple of those platforms and a couple of those experiences and games are on demonstration there for you to hear. And we own 40%, as I said, of that business. And so in conclusion, what I've shown is a different way of accessing these small businesses accelerating their value on a patient and an informed basis, which leads to a diversified portfolio of in-revenue assets that we think will be of strategic and considerable value. And what we're focusing on is that direct value in our direct assets. So the fund management business is the funnel to bring that value through. We have a flexible source, so we're not tied to 1, 2, 3 investment sources. We have a range of universities and other sources, and our relationship with our universities is a non-exclusive relationship. So we will proactively seek deal flow. And we have a very scalable operation focused on the regions of the Midlands, the North and Scotland, but a national investor in general. Please do come to a stand and ask any questions, but thank you very much for your attention.